Greetings, this is the first video regarding job order costing. Here we will delve into defining important terminology and definitions. These concepts can be found in Chapter 5 on pages 172 to 229 of the textbook. Job order costing involves jobs or a unit or a set of units, which is called jobs, which can be varied products such as job costing for washing machines or snowplowing jobs. In this managerial accounting approach, each job accumulates a cost. Next, I am going to describe how you calculate a job. When calculating a job via job order costing, there is an important equation where unit cost is equal to the total job costs divided by the output of the job. However, there are two main types of ways to go about with costing for production, which are actual costing and normal costing. In this case, actual costing involves actual direct labor. It also involves actual direct materials and overhead. These are used in order to determine the unit cost. This approach is problematic since overhead can vary and production can change throughout the year within a job, which changes the amount of overhead costs. For example, when creating the job order costing of a construction company, times of year affected by winter and hazardous weather will decrease the production and change the overhead. Also, there is normal costing, which has actual direct labor, direct materials, and an estimated overhead. The estimate is determined by approximating this year's overhead at the beginning of the year. Next, I am going to describe how to calculate normal costing. The estimated overhead used in normal costing is called the predetermined overhead rate. The predetermined overhead rate is equal to the estimated annual overhead divided by the estimated annual activity level. Predetermined overhead rate is useful for normal costing and also helps determine how much overhead is applied in a job, where applied overhead is equal to predetermined overhead multiplied by actual activity level. What is significant is predetermined overhead rate is used to calculate applied overhead, wherein applied overhead is multiplied by the actual activity level, while the predetermined overhead rate is divided by the estimated annual activity level. Next, I will discuss the main equation for normal costing. Applied overhead is computed throughout the year. Also, notably, total normal product cost is equal to actual direct materials plus actual direct labor plus applied overhead. From these previous steps, you were able to get the applied overhead, and notably actual direct materials and actual direct labor are in both normal costing, and also the applied overhead is never perfect. Once again, it's an estimate. Therefore, it is important to note that actual and applied overhead are usually different. Therefore, you have an overhead variance where it's equal to the actual overhead minus the applied overhead. This is significant later on. Next, I'm going to explain what the different types of overhead variances are called. There are two main types of overhead variance. There's an under applied overhead and a over applied overhead. An under applied overhead, the actual overhead is greater than the applied. And in the over applied overhead, the actual is less than the applied. Due to overhead usually varying and inevitably predictions of overhead aren't perfect, overhead variance is applied to the cost of goods sold, where before adjusting the cost of goods sold for overhead variance, the cost of goods sold without the adjustments is called the normal cost of goods sold. However, with the adjustments called an adjusted cost of goods sold, which is equal to the unadjusted cost of goods sold plus the under applied overhead less the over applied overhead. Finally, there is one more thing I have to mention about overhead before ending this presentation. Overhead in a large organization cannot have one fixed rate. For example, in a car manufacturing industry, having one applied overhead for every single department isn't feasible. Therefore, instead of using a plant-wide overhead rate, many organizations used a departmental overhead rate. The departmental overhead rate is equal to the estimated department overhead divided by the estimated department activity level. Notice how this is very similar to the predetermined overhead, which is estimated annual over estimated annual activity level, except this is departmental, which is estimated department overhead over estimated department activity level without the whole annual part. This concludes our first Chapter 5 video, and the next video will be the final Chapter 5 video on job order costing, which uses the concepts that we have learned here to complete textbook problems. Resources can be used at ACE and both the Bedford and Lowell Math Centers, as well as e-tutoring. Thank you for watching, and please stay tuned.